In this video, we're going to continue with the next step of moving closer to the valuation side of Apple. And now we're going to use some of the metrics that we looked at in the previous video. So EBIT, EBITDA, levered free cash flow, book value per share. And what we're going to do is go up to our summary area right here. And we're going to actually see how you use these in conjunction with enterprise value and equity value to create what are known as multiples. Now the concept of a multiple is fairly simple. You just take enterprise value right here, and then you divide by one of these metrics. So you divide by revenue or EBIT or EBITDA, or you take equity value, and then you divide by free cash flow, or you divide by net income, or you divide by book value. So the basic concept here is pretty simple. Really the only tricky part about these is that you have to be careful whether you use equity value or enterprise value depending on what multiple it is. So what I'm going to do here is go through each of them and explain how and why we use them, what kind of companies we use them with. I'll do the calculations, and then I'll allow you to get some practice also making these calculations and seeing how this works in the context of this model. So enterprise value over revenue. So this one is fairly straightforward. We're just going to take enterprise value right here. I've defined this to be a named cell, so we can just take this without anchoring it or anything like that. And I can just go down to our income statement and divide by revenue right here. I can just take this and copy it across through 2009. I'm pressing F2 just to verify that it copied across correctly. Now enterprise value over revenue, this is a very basic multiple. You look at it for a wide variety of companies in different industries, and it just sort of gives you an idea of how valuable a company is in relation to its sales. You don't rely on it. Most of the time you pay more attention to the profitability multiples below it, like EBIT and EBITDA, but you always like to look at it to have a sense of what the company is valued at. The only companies where revenue is more important or the most important metric are, for example, internet startups that are not profitable but which have revenue, or any company that has revenue but no profit is where you place the most weight on enterprise value over revenue. It doesn't really depend on the industry it's in, although it's certainly more common to have those scenarios with technology or with biotech or pharmaceutical companies, for example. In terms of industries that you never use this with or you rarely use this with, you don't really use it with banks or financial institutions quite as much because you care really more about how much they're earning after interest, so you care more about their earnings per share and book value in those cases. So you don't really use it with banks and financial institutions. But for most other classes of companies, you usually look at this even if you don't place that much weight or emphasis on it. For EV over EBIT, so once again, this one is fairly simple mechanically. We're just going to take our enterprise value and then go down to our income statement. Remember that we want to actually divide by not operating income here, but instead our EBIT calculation. The difference is that EBIT takes out stock-based compensation. So we have that, and I can copy that across with Alt-ESF. And then for EV over EBITDA, once again, I'm going to take enterprise value, go down to our income statement, and then divide by EBITDA right here. Copy this across with Alt-ESF. Okay, so when do you use EBITDA and EBIT? I would say that you use these for probably 90% of the companies that you're going to look at. Not necessarily both of them, but usually you use at least one of them. There are some exceptions, but generally you use these when you want to see how profitable a company actually is. So you want to see how valuable it is in relation to its profit or a proxy for its cash flow. So you use these, for example, for telecom companies, for internet companies, you use them for healthcare companies. You even use them for, say, manufacturing companies or companies that make physical products as well. And you may look at some other multiples in addition to these, but I would say EV over EBITDA is probably one of the most common, if not the most common multiple that you pay attention to in these valuations. When do you not use these multiples? So there are a couple of classes of companies where you don't use these or where they're not appropriate or where you maybe look at different multiples and you pay more attention to those. One example is, again, banks and financial institutions. The reason is because interest payments and interest expense and interest income there are very important, so you need to factor in interest expense, so you don't look at these. For other types of companies, so for example, for retail companies or airline companies, the rental expense is very important. So instead of looking at EV over EBITDA, you would look at EV over EBITDAR. And so you add back the rent expense here. Now, I mentioned before when we went over capital leases that there's a way to normalize for leases that doesn't involve actually calculating whether or not an operating lease should be a capital lease. And this is exactly how you do it. You look at EV over EBITDAR and you add back the rental expense. The reason you do this is because airline and retail companies have very high rental expenses. And so when you add them back, that allows you to normalize and to take out these huge expenses and to make it easier to compare different companies. Another case where EV over EBITDA is a little less applicable is when you're dealing with energy companies. With any type of energy company, usually you care more about metrics based on their oil or energy production. So you might look at a metric like price over millions of cubic foot equivalents. Cubic foot equivalents is just a metric for how much in energy they're actually producing. So with energy companies, you tend to look at those types of multiples. Now you may also look at EBITDA and EBIT for those types of companies as well, but usually you place more emphasis on multiples relating to how much energy production they actually have as opposed to what their strict profit on paper is. So those are a couple of examples of where you would not use metrics like EBIT and EBITDA. For any companies where you need to take into account interest is very important, where rent is very high, or where other metrics related to the company's core business are more applicable. The next multiple we're going to look at here is equity value divided by free cash flow. I should really label this levered free cash flow, but we know from below that that's what we're doing here. So once again, the mechanics here are fairly simple. We are just going to take our equity value and then divide by free cash flow on our income statement. Copy that across. So what is this multiple good for? What is this multiple useful for? Usually equity value divided by free cash flow is used for companies where capital expenditures are very important. So you might look at it, for example, when you have a manufacturing company or where you have any type of other company that's making a lot of capital expenditure type investments. You also use it for companies where changes in working capital, so changes in accounts receivable, inventory, and so on, are very important and represent a large percentage of revenue. And then you also use it for subscription-based companies. So for example, something like Salesforce.com or even cell phone companies, for example. Any company that collects cash up front and then recognizes it over time. The reason you use it for those companies is because when they collect cash, that really is revenue, but they're deferring the recognition of it. And so the deferred revenue change shows up on free cash flow, but it does not actually show up as revenue on the income statement. So you use equity value divided by free cash flow for those types of companies. You may also look at it for even a normal company like Apple here, but I would say it's more common to focus on when you have a company in one of those scenarios. Now the last two multiples here, PE and price to book value, so price to earnings per share and price to book value. These multiples are the most common for banks and financial institutions. You do look at PE for other types of companies as well. Sometimes you look at price to book value for other types of companies, but I would say 90% of the time you use these, you care about them most for financial institutions. The reason is because these metrics, the first one, price to earnings per share, unlike EV and EBIT and EV and EBITDA, it actually takes into account the interest expense. Because remember, going down to our income statement, that the earnings per share number here, it reflects interest income and interest expense right here. For banks, the interest income they get is very, very important, and so you want to take it into account, and so that's why you use price to earnings per share for banks and financial institutions. You may look at it for other companies as well. Really the only difference is that unlike EBIT and EBITDA, you're taking into account the company's capital structure, how much debt they have, how much cash they have, and also what type of tax situation they have when you use this multiple. So anytime that a normal company has a very high interest expense or high interest income or an unusual tax structure, maybe you'll look at price to earnings per share, but I would say most of the time you focus on it for banks and financial institutions. Price to book value, you use this for any companies where their balance sheet is extremely important. So once again, banks and financial institutions are the best example because if you think about it, they use their assets to earn revenue directly by making loans to people, by trading securities. So any company like that, banks and financial institutions being the best example, but any company that is very balance sheet centric, that is not in the mode of actually selling products to customers, but is more in the mode of using assets on their balance sheet to earn interest income, you look at price to book value. So to actually calculate these, there's actually two ways we could do it. For price to earnings per share, we could take equity value and we could just go down and divide it by net income right here. Alternatively, we could also take Apple's current share price and then divide it by earnings per share. You see here that the numbers are slightly different with both these methods. That occurs because we're using a different share count. For this current calculation, we only have 889 million shares outstanding, whereas before, when we took our diluted equity value and divided by net income, we're instead working with the 920 million shares outstanding number right here. So that explains the difference in these numbers. Most of the time they're similar, but I would say it's usually better to take price divided by earnings per share as opposed to equity value divided by net income. So let's take this and copy it across. And then for the final one here, price divided by book value. So for this one, we're just going to go up once again and get our share price and then divide by our book value per share on our income statement at the bottom. Remember from before that we purposely made sure this is a per share number because we wanted to be able to use it in this formula correctly. We wanted to just be able to take our price and then divide it directly by the book value number at the bottom. If we had not done that, then our units here would be completely messed up and we'd be off by a huge factor because we'd not be dividing by the share price. Take that and copy it. So that's how you calculate some of the key valuation multiples and why and how you use them for different types of companies in different scenarios. What I want you to do now for your exercise is to finish copying these across for the next 5 years. And I said copy, but really instead of copying them, what you should do is actually calculate them yourself for 2010 or 2011, and then you can go ahead and copy those across. This is just to test yourself and make sure you understand these concepts properly and how to actually calculate these numbers mechanically. Once you've done that, you can go back and check your work and I'll walk you through it. So pause this video right now, give that a shot yourself, and then we'll come back and we'll walk through this exercise together. Okay, good. So let's go through this now, and I'm just going to show you 2010. So first thing here, we're going to take enterprise value and then divide it by revenue on the income statement. Then we're going to take enterprise value and divide it by EBIT on the income statement. Then we're going to take enterprise value and divide it by EBITDA on the income statement. Then for this next set of multiples, we're going to take equity value and then divide it by free cash flow on the income statement. For PE, we're going to take Apple's current share price and then divide by earnings per share. And then for price to book value per share, we're going to take Apple's current share price and divide by the book value per share listed at the bottom of their income statement. So we have all these in place, and now I can just copy this across, highlight it with Shift Control C to copy it, and then Alt ESF to paste it across. We see here that the multiples are generally decreasing, which is a good sign. Multiples should almost always be decreasing because the company's revenue, EBIT, EBITDA are going up from year to year, whereas enterprise value and equity value stay the same. We're only looking at enterprise value and equity value at a specific point in time, as we have right here. So this looks correct. Everything is decreasing in a somewhat linear fashion, so this looks correct. So hopefully now you should have a better understanding of these different valuation multiples, how we use them, and some of the alternatives in case one or more of these happens to not be applicable to our company. What we're going to do in the next video is go over when you use enterprise value with the multiple, and then when you use equity value or the share price, because there's a subtle distinction between these, and I want to make sure that you fully understand it. So that's coming up in the next video. After that, then we'll get into addressing some interview questions that you can get on this topic of enterprise value, equity value, and valuation metrics and multiples.